if a firm has $700,000 in net worth and $30,000, let's say that again. If a firm has $700,000 in net worth and $300,000 in subordinations, that gives the firm $1 million in total available capital, right? So $1 million in total available capital. Okay, so what was this comprised of? This $1 million was comprised of $300,000 in subordinations, and the firm has a net worth of $700,000. So we know that these subordinations increase the firm's net capital, but we also know that the subordination itself is debt. So the subordination is debt. This firm would have a debt to equity ratio of 30%. So 300,000 divided by $1 million. So this is the firm's debt to equity ratio. Debt to equity ratio, 30%. So subordinations, subordinated loans, it is a debt obligation. They are debt. SEC rules state that a firm's debt to equity ratio cannot exceed 70% for more than 90 days. So this is an SEC rule. SEC rule. A firm's debt to equity ratio cannot exceed 70% for a period of more than 90 days. That would be really awful, right? Debt to equity of more than 70% for more than 90 days. Something's going wrong with that firm. The amount of minimum net capital that the SEC requires depends upon how the firm does business. So we know how to figure out a firm's net capital. We talked about net worth, total assets minus total liabilities. To net worth, we added subordinated loans. We subtracted haircuts to get to net capital. So we know how to do it, but we don't know what it needs to be. So there's three types of broker-dealers. So the level of net capital a firm must maintain depends upon the type of broker-dealer that the firm is. Carrying, sometimes called clearing broker-dealers, hold customers' money and securities. Introducing fully disclosed broker-dealers may receive customers' assets but do not hold them. They must promptly transmit these assets to a carrying, clearing member. And then there are broker-dealers that are mutual fund broker-dealers that act as agents for customers and transact business in investment company shares and variable annuities. Okay, so we have to make a chart. Of course, there has to be some charts. So if you think about the different firms that I described, the carrying, also called the clearing broker-dealer, they actually have custody. They clear the trades. They have the highest level of responsibility. There is the most risk for a customer when the broker-dealer is a clearing or carrying firm. These broker-dealers have the highest minimum net capital requirements. We sometimes call them general securities firms. They carry customer accounts, hence the title carrying firm, receive and hold funds, operate as clearing firms. The minimum net capital for them, now remember, these are just minimums. It might be that they need more. We'll talk about that. The minimum net capital for a clearing firm, for a carrying firm, $250,000. So that's the highest. Broker-dealers that do not carry customers' accounts are called introducing broker-dealers. So we have these different levels of responsibility. Carrying, highest. Introducing, also called fully disclosed broker-dealer, fully disclosed. Their minimum net capital requirement is less than that of the clearing firm. It is $50,000. Introducing, fully disclosed broker-dealer. Introducing firms use a carrying broker-dealer to carry the customer's accounts, accept customer funds and securities on its behalf. When the carrying firm is used by an introducing firm in this manner, the carrying firm is often called the clearing firm. It is the clearing firm that is responsible for mailing out customer confirmations, statements, and other items. So that's important. When an introducing firm clears their trades through a carrying firm, who sends out the confirmations? The clearing firm does. Customers would write their checks to the clearing broker-dealer firm. An introducing firm fully discloses to the clearing firm each customer's name and address, which is where the term fully disclosed firm comes from. Some introducing firms will receive customers' monies and securities. Broker-dealers that are introducing firms have a lower minimum net capital. We said it's $50,000. If the introducing broker-dealer does receive customers' money and securities, these specific rules must be followed. So some introducing firms would never do this, and if an introducing firm did, remember, when they organize a business in this manner, they're doing so because they don't want to have the higher net capital requirements. So in order to keep their minimum net capital requirement at $50,000, they must do these things. Introducing broker-dealers that receive customers' money or securities must ensure that all customers' monies and securities are promptly forwarded to the carrying broker-dealer, to the clearing broker-dealer. The introducing broker-dealer cannot hold customers' money or securities. They can receive it and promptly forward it on, but they cannot hold it. The introducing broker-dealer cannot owe money or securities to customers. The introducing broker-dealer can only participate in a new issue on a best efforts basis or on an all or none basis, thereby taking on no financial liability. So introducing broker-dealers cannot hold clients' money or securities. If they did, they wouldn't be an introducing firm. They would be a clearing or carrying broker-dealer. If the introducing firm does not receive customers' money and securities, then their level of net capital is even lower. So the rule, the $50,000 minimum net capital rule, is for the introducing broker-dealer firm that does receive, thus promptly forward to the carrying member firm customers' money and or securities. But the introducing firm can also say, we will not. So introducing firms that do not accept money or securities. does not accept a client's money or securities. Their minimum net capital requirement is only $5,000. So that's nothing. So the $50,000 net capital requirement, if they receive, not hold clients' money or securities. So introducing firms, fully disclosed firms that do not take clients' money or securities, it's only a $5,000 minimum net capital requirement. Broker-dealers that engage solely in the sale of investment company securities. Their minimum net capital requirement depends upon how the firm handles the customer's orders. If the firm only takes orders by subscription, so that means they'll take an application and a check made payable to the mutual fund or insurance company, could be for variable securities as well. They have the lowest minimum net capital requirement, the same as the introducing firm that does not receive a client's money or securities, so $5,000. So I'm going to put this as a mutual fund broker dealer. This also applies to variable products. Subscription basis only. Subscription basis only. Minimum net capital, $5,000. However, if the broker-dealer accepts wire orders from a customer for the purchase of mutual fund shares, then they're going to have a higher minimum net capital requirement, $25,000. So if the mutual fund broker-dealer accepts wire orders, so a transfer of money electronically for the purchase of variable products or mutual fund shares, the minimum net capital for that firm is $25,000. So when customers electronically wire an order to a broker-dealer to buy more shares, the firm would deposit the funds, confirm the trade to the customer. The firm is then required to remit the net amount due to the underwriter on the settlement date, keeping the difference, of course, as their sales charge. Because the firm temporarily has custody of customers' funds, they have that $25,000 minimum net capital requirement, where when they only engaged in the variable product transactions and mutual fund transactions on a subscription basis, thus did not have customers' funds at all, their minimum net capital is only $5,000. Sometimes fully disclosed broker-dealers, the introducing firms, and those that trade in mutual fund shares also trade for their own account. We call those the dealer transaction, the market maker. So if the fully disclosed firm or the mutual fund broker-dealer acts as a dealer occasionally, that is defined as more than 10 transactions a year in their own account, they're subject to a net capital requirement that's less than the carrying member firm, but higher than that of an introducing firm. Their minimum net capital is $100,000. So, introducing firm or mutual fund broker-dealer that also acts as a dealer, taking an inventory position. $100,000 is the minimum net capital. Once again, the rule says if they engage in more than 10 transactions a year in their own account. So that's a chart you can kind of practice with. I would definitely expect a handful of questions here. Carrying firms, what's their requirement? Highest level of liability, 250. Introducing firms that receive clients' money and securities, what's their net capital requirement? $50,000. What if the introducing firm does not accept clients' money or securities? Then it's only 5. Mutual fund broker-dealers that accept orders on a subscription basis only, 5. Mutual fund broker-dealers that accept wire orders, 25,000. What if the mutual fund broker-dealer participates in its own proprietary trades more than 10? 100,000. So just practice them, practice them. It's law. You either know it or you don't. And of course, I want you to get them all right. I made you a chart, of course, within the PDF of the course. Now, don't forget, these are the minimum requirements. We might have higher requirements you'll see momentarily. SEC Rule 17A-11 has what are called early warning rules. Early warning is the firm starting to maybe be a firm we should worry about as far as could be their net capital calculation. So what are some of these early warning rules? Early warning. Should a firm's net capital fall below 120% of the minimum, the firm must notify both the SEC and FINRA within 24 hours. Sorry, I was going to write 120%. If the firm's net capital falls below 120% of the minimum. This is the early warning rule. The firm has 24 hours to notify both FINRA and the SEC. Both FINRA and the SEC. Expansion of business is allowable under the early warning rules. This rule, this SEC rule under the Securities Exchange Act of 34 states that a violation will occur if a broker-dealer's net capital falls below the minimum requirement. That makes sense. Should that occur, the firm must file a notice with the SEC and FINRA on the day the violation occurs. It's immediate same-day notice and cease expansion of business. So this is early warning. If the net capital of the firm falls below the minimum, immediate same day notice to both FINRA and the SEC. No expansion of business. Aggregate indebtedness. Say that 5 times fast. Net capital requirements increase as a firm's aggregate indebtedness increases. So earlier I said these are the minimum net capital requirements of the firm. A firm's net capital requirement increases as a firm's aggregate indebtedness increases. Aggregate indebtedness represents certain liabilities of the broker-dealer firm. A firm's net capital requirement increases as the firm's aggregate indebtedness increases. Aggregate indebtedness includes liabilities that are not secured by a specific asset, such as money owed to customers and accounts payable. Secured liabilities are not included, such as a bank loan secured by securities that the firm owns. This exam does not care that you know every item that is included within aggregate indebtedness. You do though, need to understand the idea that the higher the aggregate indebtedness of the firm, the higher the firm's net capital requirement will be. SEC rules specify that a broker-dealer firm's net capital can only support a certain level of aggregate indebtedness, meaning that firms must comply with an aggregate indebtedness to net capital ratio. So we've got another chart. So it's aggregate indebtedness to net capital, AI to NC. Exactly what the aggregate indebtedness to net capital ratio is depends upon how long has the firm been in business. Firms that are new within their first year of business have a more stringent requirement than what we consider to be an established firm, which is a firm that has been in business for longer than a year. So this is SEC Rule 15C3-1. Broker-dealer firms who have been in business less than 1 year must not allow their total aggregate indebtedness to exceed their net capital by an 8-to-1 ratio. So first year, 8 aggregate indebtedness to 1 to net capital. So what does this mean? It means for every dollar in net capital that the firm has, they can support up to $8 of aggregate indebtedness. For example, a broker-dealer firm who accepts mutual fund orders by wire, what's their minimum net capital requirement? $25,000, yes. They can have up to how much aggregate indebtedness? Let's say they're new, they're in their first year. So if their net capital, that's the one, 25,000, this can support up to 8 times their net capital. So 8 times 25,000, $200,000 of aggregate indebtedness. Once the firm's established, been in business for more than a year, then the aggregate indebtedness to net capital ratio can be as high as 15-to-1. Established firm, 15-to-1. For every dollar in net capital they have on hand, it can support $15 of aggregate indebtedness. So that same firm, the mutual fund broker-dealer that accepts wire orders that has that minimum net capital of $25,000 can support aggregate indebtedness now of $375,000. So we just took the $25,000 net capital times 15. And so this makes sense. Established firms are less risky. Newer firms have stricter requirements. As a firm's aggregate indebtedness increases, what's going to happen to the net capital requirement of the firm? What's it going to do? It's going to go up too. That's right. we have early warning rules. So just like with net capital, if the net capital fell below 120% of the minimum, that was an early warning rule. Now what is the early warning rule? The early warning rule says if a firm's aggregate indebtedness to net capital ratio exceeds 12-1, then the firm must notify both the SEC and FINRA when, same as before, within 24 hours. Expansion of business is allowable under early warning rules, always. So obviously this rule does not apply to first-year firms because their 8-1 is their ratio. So early warning rule, early warning. Aggregate indebtedness to net capital exceeds 12-1. So they're getting closer to this 15-1, okay? Notice to the SEC and FINRA when within 24 hours. May expand business, may continue to expand business. A violation will occur anytime a broker-dealer's aggregate indebtedness to net capital exceeds the requirement. So if it's over 8-1, if it's over 15-1, then the firm must file a notice with the SEC and FINRA. When do you think? Same as before, if their net capital fell below the minimum requirement. On the same day, on the day the violation occurs, immediate same-day notice. Cease expansion of business. SEC Rule 15C 3-3, the Customer Protection Rule. This rule was enacted at the same time that the Securities Investor Protection Corporation was created in the early 1970s in response to a large number of broker-dealer bankruptcies. The Customer Protection Rule has two parts. Customer protection. A possession rule and a reserve requirement rule. So customer protection rule, a possession rule, and a reserve requirement rule. The possession rule requires a carrying broker-dealer to daily bring into possession, in-house, or under control in an account controlled by the firm, all fully paid customer securities and all excess margin securities. Each day, the carrying firm must, prior to the day's settlement, ensure that it has physical possession or control over these securities. Control locations include clearing corporations, such as the National Securities Clearing Corporation, depositories, such as the Depository Trust Company, commercial banks, and other broker-dealers. So, an actual physical possession of the securities owned by the customer and all excess margin securities, those that have not been pledged as collateral to a bank for the loan given to the customer. The reserve requirement rule requires that all carrying broker-dealers each week, as of the close of business on Friday, determine monies owed to the members by customers, these are called debits, and monies owed by the firm to customers, these are called credits. If the credits exceed the debits, then the firm is basically using customers' money to do business. If the credits exceed the debits, that means that they owe more money to the customers than customers owe them, basically. The reserve requirement rule states that if credits exceed debits, this excess must be deposited somewhere safe. A special reserve account, it's called. When, within 1 hour after the banks open on the second business day following the day of computation. So if this rule must be done each week as of close of business on Friday, generally speaking, the second business day is Tuesday. Most banks open at 9, so by 10 a.m. on Tuesday morning. The excess, where the credits exceeded the debits, must be deposited in a special reserve account. So the customer protection rule, it's a rule that applies to clearing broker-dealers. They're the ones that have custody of the client's money and securities. This special reserve account can only be funded with cash or U.S. government securities. Those, of course, are safe. Don't say that to your client. But it has to be very liquid. So cash, U.S. government securities, including bills, notes, bonds, tips, and Ginnie Maes. Firms that fail to make the required deposit must send immediate notice both to the SEC and FINRA. Mutual fund broker-dealer firms whose customers make their checks payable directly to the mutual fund, and introducing firms who promptly transmit all customer funds and securities, do not owe money or securities to customers beyond the settlement date, are exempt from the customer protection rule. So, like I had said, this customer protection rule really is for clearing these carrying general securities firms.